As a business owner, you might start by asking yourself the following questions. What are my personal short-term, medium-term, and long-term goals and objectives for after selling the business? What do I plan to do after the sale of the business? What measurable goals should I set? Over and above other sources of capital and income, how much will I still need to afford everything I want to do and still maintain an adequate standard of living throughout retirement? Do I wish to remain in the business after its sale? And for how long? In the event of my death, do I need to or want to leave money to my family, to charity, or both? In the light of all this, when do I really want to transfer management, ownership, and control of the business?
It allows the owners, shareholders, and partners the opportunity to coordinate business succession plans with their own estate plans to take advantage of tax deferral opportunities. And it contributes to peace in the family and the assurance of financial security.
Quite right. If the objectives are defined as dreams and aspirations, goals might be what it takes financially to achieve them and the time to achieve them. For example, a person's first and most important objective or dream could be that the couple should have a comfortable retirement after raising their children and educating them. To achieve such an objective, the couple would need to achieve a goal expressed in dollar terms to be reached by a certain date. Example, have a fully paid home and have sufficient money invested by the time they retire in 2030. A person might need, in today's dollars, $1 million, $5 million or more, depending on their lifestyle. Let us then list a few other personal objectives and goals that might be considered by a business owner. How much do my spouse and I need to cover living expenses after retirement? $2,000 monthly, $15,000 monthly, or more? How much will my spouse and I need to cover living expenses should we have no other sources of income? How much will my spouse need to cover living expenses should I predecease him or her? $1,500 a month, $7,000 a month, or much more? How much will I need to cover living expenses should I be widowed? $1,500 a month, $7,000 monthly, or much more? Do we plan to move to a retirement home? By when? 2025, 2030? Will my spouse and I need special care, and when? Am I going to help with the education of my grandchildren? What will it cost? $100,000? $200,000? Would I like to start a family trust and create a long-lasting legacy? How much do I want to have accumulated in the trust by then? $1 million, $5 million, or more? Do I plan to leave my children and grandchildren something after I die? Perhaps to help them buy their first home, say $200,000 each. Am I going to travel, play golf, sail the world, curl in the winter and lawn bowl in the summer? Perhaps spend $25,000 or $50,000 annually on travel and entertainment? Am I selling up and moving to another country or city? How much will this cost, and when? Do I plan any major purchases, buying a car, perhaps a cottage, or buy an income property? How much would all of this cost? Am I going to take up employment after selling my business, do charitable work, start another business? How much will I earn? How much should I invest in starting another business? Do I plan to leave money to charity, and how much?
Can you elaborate on the steps you consider important in business succession planning?
Absolutely. It is critically important that one's personal dreams, objectives, financial goals, and timeline be realistic. It is probably preferable to be conservative in one's outlook because we all have witnessed enough to know that oftentimes things don't turn out as planned. The last thing one wants is to have to start looking for work 10 years after retirement, a rather frightening prospect.
A business succession plan has to tie up to the owner's personal lifetime objectives and goals. What order would you recommend be followed? Would you not consider the importance of a person's or family's financial situation after the sale of the business?
Yes, every point you have just made is most important. Let us start at the very beginning. I always suggest that a business owner embarking on succession planning should start by establishing what the business is worth should it come up for sale and how much his share of it is worth. Depending on how much the business is worth, the business owner can look at ways to minimize taxes on the transfer of the business. Some business owners may consider establishing trusts, life insurance, charitable giving, and other estate planning considerations. Depending on what the business owner needs to sell the business for to finance retirement or the estate in the event of death, he or she may consider taking steps to improve the value of the business before the final sale. The unexpected, such as disability or death, should also be seriously considered by business owners as part of their business succession plans to ensure business continuity, its successful transition to new owners, and most importantly, to ensure their families are left sufficiently well off financially. It goes almost without saying that, as part of contingency planning, business owners should keep their wills and powers of attorney up to date. A person should calculate the amount of income and expenses to live on in the event of having to stop work. Preparing a list of one's current assets and liabilities at realistic values is a good start. Values should be realistic and realizable should the business and other personal assets need to be sold to finance a planned retirement or a forced retirement. In the event of critical illness insurance benefits should be considered. All sources of income should be taken into consideration, such as CPP, old age security, RSPs, and RIF income, income from non-registered financial and real estate investments, income from remaining business interests, disability insurance or disability benefits, long-term care insurance benefits. The other thing to do is to list all current living expenses and from these values calculate the living expenses in the event of retirement. A forced and premature retirement may cause one to set aside the realization of many personal dreams.
I take it that once all the personal dreams, objectives, and goals are identified realistically, then the business owner can focus on the business goals and objectives he needs to address before retirement or in the event of death.
Quite right, Damien. The sale of a pricey principal residence in Canada's major cities often represents a large amount of capital that can be used for retirement. The capital gains on the sale of a principal residence in Canada, as you know, are free of taxation. Registered savings plans and TFSAs are also an important source of capital to be used in retirement. Business owners, however, have a few other options to them to save for retirement.
Many people, if not most, save for retirement through RSPs. Incorporated business owners have other additional tax-efficient retirement options such as individual pension plans, also known as IPPs, and registered savings plans, also known as RSPs.
IPPs, or individual pension plans, are defined benefit plans, while RRSPs, or registered savings plans, are defined contribution plans. If a business owner is incorporated, an IPP should be considered as an alternative to a RRSP, particularly because IPPs are best suited for high-income individuals over the age of 40 who are owner-managers or key executives of incorporated companies with stable cash flow. These would be some of the possible benefits associated to IPPs. Note that, due to different personal circumstances, what might be considered as a benefit for some individuals might be considered as unsuitable to others. IPP contributions are tax deductible by the employer, while RRSP contributions are deductible by the employee. IPPs are locked-in defined benefit plans, while RRSPs are unlocked defined contribution plans. The topping up of IPP contributions is allowed, while for RSPs, no contribution topping up is possible. IPPs allow for a higher level of contributions than the known maximum amounts allowed with RRSPs. Being a defined benefit plan, IPPs provide defined benefits, while RRSPs and RIFs have variable benefits. IPPs have a higher cost of administration than RRSPs. However, IPP costs are paid by the employer. Since the amount of money that may be contributed to an IPP is greater than may be contributed to an RRSP, the IPP generates a greater upfront tax deduction. Business owners with IPPs have a few options on reaching retirement. They may opt for a fixed retirement pension coming from the IPP. They may transfer the commuted value of the IPP into a locked-in plan, a LIRA or locked-in account. Or they may purchase a life annuity from an insurance company. It should be noted that with a locked-in plan, there may be maximum limits to the amount a person can withdraw to receive each year. This is not the case with RRSPs and RIFs, as there are no maximum withdrawal limits. So depending on the expected lifespan of the individual wishing to embark on an IPP or an RRSP, one retirement plan may be seen as preferable to the other.
A retirement compensation arrangement, RCA, is a retirement planning vehicle an incorporated owner-manager may consider.
A retirement compensation agreement, or RCA, is a non-registered pension plan funded by the employer, in this case, the corporation, to provide income for the employee in the event of retirement or loss of employment. The employee may contribute to an RCA as well. Contributions to an RCA are tax deductible. The income earned inside an RCA is tax deferred until the employee receives payment from the RCA. 50% of RCA contributions made to the plan are remitted to the CRA, Canada Revenue Agency, as refundable tax. 50% of any income, interest, dividends, capital gains earned inside the RCA plan is also remitted to the CRA, Canada Revenue Agency, as refundable tax.
Could you translate that into dollar amounts to better understand the workings of an RCA?
For every 100,000 contributed to an RCA, 50,000 goes into the RCA trust to be invested. The remaining 50,000 is held in a refundable tax account with the Canada Revenue Agency. In retirement, income is paid out of the RCA trust. For every $1 paid out from the RCA trust, 50 cents is put back into the RCA trust from the RCA refundable tax account. A RCA can be used to supplement retirement income for high-income earners. An RCA can be used when the maximum retirement pension payable from an IPP is much less than the person's current income or income needs in retirement. Business owners with a need to reduce their corporation's income to the small business deduction limit may wish to defer immediate tax by transferring funds to the RCA rather than paying bonuses to themselves to draw out at a later date when they may be in a lower tax bracket. For those who plan to retire outside of Canada, as non-resident in Canada, they may only be subject to a maximum level of Canadian withholding tax on withdrawals, which may be much lower than today's tax rate. RCA is also good for creditor protection.